before we continue with our discussion, let's take a quick look at another viewer's question we received. It came from Bradley in Stellenbosch, and Bradley asks, I'm a young South African who's investing for my retirement. Should I diversify into offshore funds? Now, diversification is something that we've already picked up in the first half of the show. Perhaps a fresh look at diversification. Kirby, from your point of view.
Yeah, I mean, look, for diversification is one of the tools that you use in asset management in order to try and mitigate risk. And that's kind of the textbook answer around diversification. I think a better, if I just look at the viewer's question here, I think the first thing that one has to take into consideration, Shaun, is what is his needs? What is it that what he's trying to achieve? And I mean, in this case specifically, he's quite young, and he potentially has quite a long period to go before he has to retire. And that's obviously taking, making sure everything else is, kind of equal, and that he doesn't actually need money before he gets to retirement age. All of that will play into what kind of diversification he requires, how much of it he requires, and where he potentially then places his assets. And that might take into consideration some offshore assets, what could potentially mean that he leaves all his money potentially here in South Africa.
Depending on, again, what you said, the needs are.
Yeah.
Let's assume someone sits back and says, okay, I've decided now and I've met with somebody, I need to be investing offshore directly. What is the typical process one has to go through to get it abroad?
The process can be, it's actually made quite simple in terms of the investment companies now that we use. But the idea really is that you have to apply for actual SARS clearance. Now, the first thing that you would have to make sure is that all of your taxes are completely up to date. Make sure all of your tax returns are in, and make sure that you don't owe SARS any money, because that immediately would stop the process that SARS would actually give you that clearance. Once you've actually applied for that whole clearance certificate, they're also going to be asking with that clearance certificate in terms that they want a full list of your assets and liabilities. So the idea is get all of that sort of information together beforehand, and it just helps to make the whole process a lot more seamless in terms of trying to provide the information to SARS. Sure. From that point of view, you would basically get a certificate which effectively would then allow you to invest. And that certificate is only valid for a 3-month period. So it's really important for a person to make sure that they understand and know where they want to invest, what the process is going to be beforehand. Otherwise, what generally happens is someone just goes and applies for the offshore exposure, they're in a position that they get the certificate, then they start looking around, and once the whole process has taken time to actually make a decision, that 3 months is up, and then they're in a position that they have to reapply for that certificate.
Once again.
So the idea really is try and get a full idea in place what you want to do, and then from that point actually do your application through the investment company.
Perhaps easier than before, but still quite involved. Mark, obviously it brings up the question, especially if you are looking at diversification, if someone has invested offshore, suddenly rebalancing needs to take place. What is it that person needs to look at, and are people doing this?
Well, I mean, it also depends on the growth of the assets themselves, because if you have a large amount of growth over a couple of years, the offshore portion will start to form a larger weighting in a person's portfolio than before. There's no need to ever bring money back in terms of legislation from your offshore investment, but as we said a little bit earlier before, we need to make sure that the various asset classes are being managed and balanced out according to the person's risk profile. We in particular focus on risk, so we don't go that much aiming at performance objectives, but rather risk objectives, which is part of the diversification argument. So we just need to make sure that if we have, for example, a moderate investor, that we still have, around a quarter, say, in fixed income, and a quarter in cash, and a quarter in equities, and a quarter in property. And
even from a global point of view?
From a global point of view as well, because the risk characteristics of the various asset classes, whether domestic or in any country around the world, will typically be quite similar.
Kirby, obviously, I mean, we lived in the recent past through the global financial crisis. I think a lot of people used to look towards the developed economies saying, that's safe, even more so. Take a bank that's in a developed country, that's even safer. We saw what happens. Surely everyone's sitting back and looking at risk very, very differently.
Yeah, I mean, certainly. I mean, I think, firstly, I mean, the one thing that the subprime crisis had taught and the ensuing banking crisis is the way in which we extrapolate risk and understand risk from a mathematical perspective is potentially maybe wrong. And we could potentially, look at it in various other ways in order for it to make more, much more sense than what it is at the moment. And that's why you see a huge amount of think tanks at the moment thinking about risk and how they should potentially be extrapolating it and thinking about it. It is the mathematical way, really the right way to be able to, to look at risk. And that is why also you see at the moment this complete kind of assets across the globe aren't behaving normally at this stage. You've got assets in G7 which look very differently, potentially of far better quality historically, trading at far lower, or shall I say far better multiples than what you're seeing, for instance, in emerging markets at this stage. And
Absolutely.
that's, so you're seeing a whole rejigging as far as this is concerned. And if you're an investor in South Africa and you're busy trying to invest offshore, well, the first thing that you're doing from a historical perspective is you're looking at the last decade worth of returns, and those aren't looking pretty. And that's the first thing that most people are doing, is saying, well, it didn't look that great.
Yeah.
Why should this then continue looking? How should this look potentially going forward? And all those things are questions that I think many investors should be asking themselves before they start investing offshore and before they start understanding what they should be doing internationally.
I think we spoke a little bit about the behavioral biases. A lot of people make emotional decisions going over there.
Yeah.
I think a lot of people look towards developed economies and say, I want to get better returns out of my money from going into a developed economy. History's taught us that if it's just returns that you're after, perhaps offshore's not the place to be.
Yeah, emerging markets generally, because they just expand at a far more rapid rate, generally just give you far better returns than you could potentially get out of big Western economies. And there is obviously the divide. If you want to be in emerging markets, there's a whole myriad of options that you could potentially look at, other than potentially being in South Africa.
Yeah.
I think the big issue, and sorry, again, that's from a historical perspective. Again, that has certainly been the case. Over the next decade, as we continue to see economies start accelerate and continue to recover, that situation might reverse itself, and you might actually start seeing some fairly good returns out of international markets. I just take some companies that are trading internationally, and if you look at their counterparts in South Africa is far richer in price as far as the international counterparts are concerned. And I mean, if that just kind of, and most of those companies are multinationals. They don't operate within one geographic region. It's currency and multi-country type companies. Surely that must be a buying opportunity. The question is, what time period, how long are you prepared to do this, and are you doing it because there's a currency potential volatility you're introducing here.
Sure.
That's always the reason why I say to people, rather take your excess capital and go overseas. Take your capital that you need to live off and try and do that here in South Africa. Try and do it, because it has to grow, because you sit within a very specific inflation environment in South Africa. Inflation environment internationally looks completely differently to your inflation environment here in South Africa. So don't use assets that you need to live off, rather use excess assets to go overseas.
Absolutely, and as you were talking, I'm seeing nods from the other guests, so I can take it as confirmation that's perhaps how people should be looking at it. Certainly, we've run out of time, unfortunately. I've enjoyed the discussion, and thank you so much for your time and expertise on this topic. Before we go, it's time for a quick look at our weekly viewers' tips. This week, of course, our tips relate to offshore investing.
As you are aware, the rand is currently very strong against other currencies. So now is the time to increase your offshore exposure. This is a great way to diversify your investment portfolio and achieve the recommended 20 to 30% exposure, which is necessary to optimize your returns. People have different reasons for looking to invest offshore. It is important to understand your reasons before you choose your course, as this will help you to decide between investing in asset swaps or taking your money offshore. Your decision to utilize offshore investments should be based on whether you want to retain your money abroad or whether you want and need your money in rands. Current exchange control regulations allow all South African residents over the age of 18 to take a maximum of 4 million rand offshore. This gives spouses 8 million rand allowance. In order to invest offshore, one needs to obtain a tax clearance certificate from SARS. This can only be done if you're completely up to date with your taxes. This certificate is only valid for 3 months, so make sure you have decided on your investment strategy before you apply. In addition to this, you will also need to provide SARS with a comprehensive list of your assets and liabilities. When investing offshore, you should have a long-term investment horizon in mind to iron out the market volatility and the currency deviations. Offshore exposure can be easily attained by all South African investors through asset swaps, where you invest in rands and earn in rands, leaving the technicality of investing offshore to the experts. This is the easiest way to achieve offshore exposure on your investment portfolio without the hassle of obtaining tax clearance. Current legislation allows investment houses to invest up to 30% of your investment offshore on all non-retirement funding vehicles. Retirement annuities, pension and provident funds are limited to 20% offshore exposure. The best part of an asset swap is that you are not limited to a rand value offshore. When considering your offshore exposure, don't only focus on developed markets. Economists have identified emerging markets with a special focus on Africa as the area to boom over the next decade. So don't miss out on the action. A FinLogic financial advisor can help you create your wealth through offshore investments.